Welcome to the Deep Dive. If there is one story, just one, that is absolutely dominating the Bloomberg terminals and every single investment discussion this week, it is the unprecedented financial shockwave coming out of Venezuela. And this isn't just a political story. I mean, not at all. This is a story about asymmetrical risk, about financial mechanics, and an explosive revaluation event that just has no peer in recent memory. The market reaction following the capture of Nicolás Maduro and Cilia Flores has fundamentally changed how we calculate political risk and, deep value in emerging markets. But before we really dive deep into the financial intricacies of this upheaval, we want to take just a moment to thank the partner who makes this all possible. This analysis, which we are recording today, Thursday, January 8, 2026, is made possible by the support of our longtime sponsor, Broker 360. Now, if you are based in Argentina, or if you maintain financial interests or, travel a lot in the region, you really need to know Broker 360. They're true experts in managing insurance policies across all sectors: auto, home, commercial properties, whatever you might need.
So if you're moving assets or if you just need that peace of mind that comes from a really well-managed, secure policy, they provide that essential foundation. You can find their direct contact information, their WhatsApp, website, email, right on your screen or in the description of this deep dive. It makes it super easy to contact them. Once again, thank you, Broker 360, for supporting the kind of granular, in-depth analysis we do here. We truly value our partnership. Okay, let's turn our attention to the Venezuelan market. The question that's echoing in every trading room from New York all the way down to Santiago is whether it actually makes financial sense to invest in the equity of a nation emerging from such a delicate and devastating situation. The sheer numbers we saw this past week, they seem to defy all conventional financial logic.
They do. They defy conventional logic, but only if you hold a static view of political risk.
Right. Yeah.
What we're witnessing is a violent revaluation, yes, but it's one that is profoundly logical at a deep, deep financial level. We're sitting here on January 8th, 2026, and we're looking back at a week that was nothing short of a financial earthquake.
Not a tremor.
No, not a minor tremor or some gradual adjustment. This was a definitive structural rupture.
Okay, let's unpack this. Let's talk about that rupture. We're defining the unprecedented event as the military Operation Absolute Resolution, which culminated in the capture of Nicolás Maduro and Cilia Flores in the first week of January. And this operation did more than just dismantle a political hierarchy, as you said. It detonated a massive repricing event across all asset classes linked to Venezuela.
That term, repricing, is absolutely critical. It's what distinguishes this from just, irrational speculation.
Right.
What we saw was the abrupt materialization of what we call a positive tail event. For almost a decade, financial models were all built on the assumption that the scenario we just witnessed, the definitive removal of a sanctioned executive, was nearly impossible. It had a tiny probability weighting.
So the prices were just crushed.
Exactly. Market valuations were deeply, deeply compressed as a result.
And what were the immediate impacts, the visceral impacts of that tail event finally happening? Give us the figures, because they honestly feel like they belong in a textbook on financial anomalies.
The reaction was, it was truly unprecedented. The Caracas Stock Exchange, the BVC, which is often this obscure, thinly traded exchange, suddenly became the global epicenter of volatility. The main index, the IBC, it jumped over 70%.
70%.
In 1 week. In a single critical week. But maybe even more striking was what happened in the debt markets. Sovereign bonds, which had basically been relegated to the status of zombie papers, they've been in default since 2017, untouchable because of sanctions, they literally doubled in value in a matter of days.
So our mission in this deep dive is to dissect exactly why this mechanical reaction happened. We need to focus on the pure mechanics of the trade, the psychology behind it, and why this sudden shift unlocked this massive deep value opportunity. We need to show our listeners this wasn't random.
No, not at all. It was the sudden realization of repressed intrinsic value, and it demands a forensic dissection. To really grasp the sheer magnitude of this, we have to start with the catalyst itself.
The military intervention.
Right. Unlike a slow, negotiated political transition, a direct military intervention is a systemic rupture. It forces all market actors, from the smallest local broker in Caracas to the biggest hedge fund in London, to simultaneously recalculate their risk premiums overnight.
There's no time to adjust.
No, you can't hedge against this kind of sudden, comprehensive political removal.
So let's frame that event. The capture happened on January 3rd. That date is the definitive moment, the one that shattered a decade of this risk compression you mentioned.
Precisely. The detention of Maduro, and specifically under these long-standing narco-terrorism charges, is key. It eliminated the primary political and, just as importantly, legal barrier that kept Venezuela isolated from Western finance.
The sanctions on the executive.
Exactly. The presence of an executive sanctioned by the G7 nations was the legal poison pill for any foreign capital. With him removed and in federal custody, that fundamental legal block just vanished.
Okay, so what about the immediate response on the ground in Caracas? Delcy Rodriguez was designated as the interim president. In a vacuum, you might see that as just continuity of the same political structure. How did the market read that?
The market's reading was entirely pragmatic. It saw the designation of Delcy Rodriguez as an act of capitulation, not continuity.
A surrender.
Yes. The key signal was the lack of any real military resistance and the physical reality of Maduro's detention. That trumped any immediate political maneuvering in Caracas. But the most potent signal, the one that truly drove the financial repricing, came from Washington.
You're talking about President Trump's statements.
Indeed. President Trump's public assurances were absolutely critical. He explicitly stated that the United States would direct the transition process, and crucially, he promised that U.S. oil majors would enter to fix the infrastructure.
And Wall Street doesn't operate on ideals.
It operates on implicit guarantees, and that's what they heard.
So that's the core thesis of this move, isn't it? Wall Street didn't just hear rhetoric. They heard a sovereign guarantee that their capital would be protected.
Exactly. Investors interpreted this as an implicit guarantee of judicial security and, even more importantly, a certainty of a U.S.-backed economic recovery. The promise that massive American oil companies would be deployed to rehabilitate PDVSA to get the world's largest oil reserves back online. That signaled that Venezuela's recovery was now a priority foreign policy project for the United States.
And that changes the whole cash flow projection for the country.
It radically changes it.
We did see some rhetorical condemnation from countries like Russia, China, and Indonesia about violating sovereignty. But our sources are stressing that for financial markets, this was just irrelevant background noise. Why?
Because the financial reality was just overwhelming. For capital, the operational control of the world's largest oil reserves was moving, decisively, into Washington's sphere of influence, geopolitical maneuvering. It gets discounted when factual operational control shifts like this.
So words don't matter as much as actions.
Not when you weigh diplomatic condemnation against the certainty that a massive influx of financial and technical resources, backed by the U.S. government, is about to be mobilized. Resources that no isolated Chavista administration could ever hope to acquire. The sanctioned person was gone, and the system was opening up. Simple as that.
Okay, let's shift to the fundamental financial concept here. The collapse of the political risk premium. Before January 3rd, Venezuela was a pariah state. Explain the mechanics of this political risk premium that was so suddenly dismantled.
Sure. The political risk premium is essentially the extra discount you apply to an asset's value, or, the higher yield you demand as an investor, to compensate for the risk of political instability, of expropriation, of crazy regulations, or simply the risk that you can't get your profits out of the country.
So every asset was marked down. Heavily.
Heavily. Before the intervention, any intrinsic valuation of a Venezuelan asset was massively discounted. The models assumed a near zero chance of positive political change and a very high risk of things just getting worse under sanctions. Basically, the price reflected a distressed liquidation scenario.
So the intervention didn't just add value, it completely inverted the entire risk equation.
It flipped the script, 100%. Investors immediately started discounting a scenario we can call forced normalization.
Forced normalization.
Yes. The expectation pivoted from continued decay to mandatory market-driven reforms, all enforced by U.S. supervision. This means a clear path to debt restructuring, privatization of inefficient state assets. The political uncertainty that demanded that huge discount was replaced by the certainty of a mandated capital-friendly transition.
And that's the change that transforms Venezuela from an uninvestable pariah into a massive, deep value opportunity. In essence, the intrinsic value of the physical assets, the oil reserves, the infrastructure, the land, suddenly has a credible short-term way to be realized.
Precisely. And to put this in context for our listeners, deep value investing is often about buying assets for less than they're worth on paper or less than they'd cost to replace, and then waiting for a catalyst to unlock that value.
And in this case, the catalyst was geopolitical.
The discount was almost entirely political. When that geopolitical catalyst arrived, the intrinsic non-political value, the sheer scale of the oil reserves, was just unleashed. Without that implied guarantee of U.S. resources and technical support, this revaluation wouldn't hold. That's what validates the deep value thesis. It signals a fundamental change in the capital structure and the perceived safety of those assets.
Let's dig into what that promise of U.S. resources specifically means for the capital structure. Because it's not just abstract goodwill, is it? It's a guarantee of the technical know-how needed to fix a completely broken system.
Absolutely. Think about PDVSA. Its operational capacity has been just degraded by years of mismanagement, corruption, lack of maintenance. The oil is still there, deep underground, but the machinery to get it out, to refine it, to ship it, it's broken.
As the U.S. guarantee fixes that.
The implied U.S. guarantee assures the market that this deficit will be bridged. It means massive capex injections and the transfer of essential technology and management. And that, in turn, means the country's ability to generate hard currency will recover.
Which is what you need to pay debts and profits.
It's the ultimate backing for any future debt payments, any equity profits, any repatriation of capital. The political shift made the economic turnaround physically possible. That is the definition of unlocking a repressed balance sheet.
Okay, so having understood the geopolitical context and this idea of risk inversion, let's zoom in on the specific asset class that showed the most immediate, visceral excitement. The Caracas Stock Exchange, the BBC.
Yeah.
The figures from this week are they're essential for understanding the psychological shift.
Oh, they're a perfect case study in market behavior under extreme political stress relief. The IBC closed on Friday, January 2nd, at 2,230.81 points. It was that kind of tense calm, that often comes right before a huge event.
Guide us through the chronology of this price explosion. I want to emphasize the sheer speed of the shift from just profound pessimism to outright market euphoria.
Okay. Monday, January 5th. That was the initial test. Maduro was in custody, and the orderly nature of the operation was confirmed because there was no organized internal resistance. The index closed up plus 16.45%, hitting 2,597.68 points.
So that was the first wave.
That was a positioning of the early adopters, investors who correctly read the lack of conflict as confirmation that the transition was not only real, but could actually be orderly.
16% in a single day is a colossal gain for most global exchanges. But Monday was just the appetizer for what came on Tuesday.
Tuesday, January 6th was the day of the melt-up. This was pure euphoria. It was panic buying. The index skyrocketed an astounding plus 50.01% in a single session. It closed at 3,896.77 points.
50% in one day. That is statistically aberrant, even in the thinnest frontier markets. It's what they call a multi-sigma event. For our listeners who might not deal with this kind of volatility daily, what on earth causes an impossible jump like that?
It was a vicious combination of factors. Primarily, it was FOMO, the fear of missing out, but critically, it was driven by a complete vacuum of sellers.
Nobody wanted to sell.
Why would you? Existing shareholders who were suddenly faced with the prospect of their near-worthless paper being revalued into a promising asset, they just instantly pulled all their supply from the market. The massive demand shock simply overwhelmed the zero liquidity that was available.
So buyers had to chase prices up.
They were forced to aggressively raise their bids, creating these enormous price gaps where prices had to jump 50% just to find any willing seller. That day cemented the narrative. The transition was irreversible, and all the previous prices were fiction.
And the momentum didn't even stop there.
No. Wednesday, January 7th, the market consolidated those gains, adding another plus 14.42% to close at 4,458.84 points. So the cumulative appreciation across those three sessions was almost plus 99.8%.
The market doubled in 72 hours.
It effectively doubled its value. This wasn't fundamental analysis catching up. This was the market desperately trying to discover a new equilibrium price in a world that had fundamentally completely shifted.
Looking at the sectors, was this a generalized, a rising tide lifts all boats kind of phenomenon, or did the money concentrate in specific places?
Oh, it was highly concentrated. The capital flowed selectively into sectors that were seen as having the greatest leverage to the economic opening. The banking and financial sector was the undisputed leader. The financial index soared 53.40% on that explosive Tuesday alone.
Let's talk specifics. Banco Provincial, which is backed by Spain's BBVA, and Mercantil Servicios Financieros. Why did the banks lead the charge so aggressively?
The investment thesis there is powerful, and it's multifaceted. First, there's the expectation of a drastic easing of these suffocating regulations, particularly the legal reserve requirement, the Nkeji legal.
Explain that for us.
It was a requirement that had basically frozen the vast majority of bank deposits, completely crippling their ability to lend. It turned them into mere processing entities. Liberating that reserve would instantly reactivate credit, turning the banks back into engines of economic growth.
Okay, that makes sense.
And secondly, these institutions are expected to be the primary pipes for the massive foreign capital flows needed for reconstruction, and the international backing of a bank like Provincial from BBVA that provided an extra layer of perceived security, making it really attractive to institutional money.
Then we have the real estate sector, represented by Fondo de Valores Inmobiliarios, or FVI. This is a bet on tangible, physical assets.
Correct. FEI represents tangible value corporate offices, commercial real estate in key parts of Caracas. These assets were trading at a tiny fraction of what it would cost to build them today. Political stability promises an accelerated revaluation of these properties as multinationals and returning businesses start looking for prime space.
So FVI is basically a leveraged bet on the normalization of urban economic life.
Exactly. And it serves as a classic hedge against future currency volatility. You're locking your capital into real assets.
And finally, let's talk about the strategic asset that saw a massive turnaround. CANTV, the state-owned telecom company.
CANTV's sharp rise was driven entirely by expectations of privatization or a strategic alliance. The infrastructure is, frankly, in terrible shape, but the company holds a dominant, almost monopolistic market position.
So the value isn't in what it is, but what it could be.
Precisely. The possibility that a pro-market interim government would open the telecom sector to foreign investment for modernization, partnerships with global giants like Telefonica or American carriers, that instantly revalued CNTV. It shifted overnight from being an inefficient bureaucratic liability to a strategic national asset with enormous turnaround potential. Investors are betting on the sale, not the existing operation.
We've dissected the what and the why of this market reaction. But before we dive into the technical, how the mechanics of that 50% jump and the massive institutional play in distressed debt. If you are finding this granular analysis valuable today, we'd invite you to subscribe, leave a like, and please let us know in the comments what complex global financial topics you want us to do a deep dive on next. In the description, you'll find two important links. One to our trusted sponsor, Broker360, and another to PayPal if you wish to support this project directly. Your support helps us dedicate the exhaustive research time needed to deliver this level of sophisticated analysis. We really appreciate it. Thank you for helping us continue this work. Okay, let's transition now to the core of the technical analysis, Section 3. This is where we satisfy the curiosity of our listeners who want to understand the market's plumbing. How did a market even allow a 50% jump in one day?
This analysis would be completely incomplete without looking at the microstructure that allowed for such extreme volatility. The key lies in a concept that has long plagued the BVC, chronic illiquidity.
Explain that relationship. The BBC is known as a thin market. It's characterized by historically low trading volumes, small market cap.
Exactly. And in this case, illiquidity acted not as a dampener, but as a massive leverage point for volatility. When the definitive news of Maduro's capture hit the wires, the supply side, the sellers, the ask side liquidity, it just vanished instantly.
Right, because why would you sell?
Shareholders who had been desperate to liquidate suddenly realized their assets might be worth 10 times more in a month, so they pulled their offers. This created a profound demand shock against basically zero supply.
And if the supply evaporates, the buyers have to get exponentially more aggressive.
Precisely. Buyers, especially those who needed to get a position on quickly, were forced to raise their bid prices aggressively, creating what we call price gaps.
A gap where no trades happen.
It's a discontinuity. The stock value jumps from level X to level Y with nothing in between. The key insight here is that it took relatively little fresh capital in dollar terms to move the entire market cap by 70%. There was virtually no counterparty supply to absorb the demand and slow it down. Illiquidity didn't just maximize volatility, it weaponized it.
This technical reality, though, brings up a critical regulatory question. Globally, organized markets use guardrails or circuit breakers and price bands. These things are designed to prevent exactly this kind of chaotic price action. So how could a regulated exchange permit a 50% single-day jump?
That is an excellent, very sophisticated question. In established markets like the NYSE or the NASDAQ, if a stock or an index moves beyond a certain limit, say 10% or 20%, the system halts continuous trading and it starts a volatility auction.
To cool things down.
Right. It stops the immediate panic and allows everyone to place new orders and find a new equilibrium price.
So the BVC must have used this mechanism, or maybe just repeatedly overridden it.
The sheer size of the Tuesday jump, that plus 50.01%, it strongly suggests that the leading stocks entered a state of suspended or volatility auction, over and over again throughout the day. But instead of stopping the action entirely, the BBC authorities likely allowed the market to rapidly discover the new price level.
Why would they choose discovery over stability, knowing the risk of it overheating?
I think the crucial conclusion is one of regulatory pragmatism. The BBC authorities, understanding the unique existential nature of this political event, they recognized that restricting the surge artificially would have only choked the legitimate repricing process.
And it would have just pushed trades elsewhere.
Exactly. It would have immediately pushed most of the transactions to the unregulated, opaque over-the-counter or OTC space, where prices are even less transparent. By letting the market run, they channeled the euphoria. Chaotically, yes, but through the regulated exchange. They kept control over the settlement process. It was a calculated risk to embrace extreme volatility to achieve rapid price discovery.
There is a critical detail in our source material that we have to stress, especially for our Latino audience, that deals with regional inflationary economics. The difference between nominal gains from inflation and real dollar returns. Was this market rally just a mirage caused by the Bolivar devaluing?
Absolutely not. And this is the detail that provides the ultimate validation for the fundamental repricing thesis. During that critical week, the VH-USD exchange rate, both the official and the highly tracked parallel rate, remained remarkably stable. It fluctuated in a narrow band between 300 and 320 bolivars per US dollar.
The significance of that stability cannot be overstated.
But it's fundamental. It means that the massive, greater than 70% increase in the IBC was not currency manipulation. It wasn't inflation masking stagnation. It was a genuine fundamental revaluation in hard dollar terms. An investor who got in on Monday effectively saw a real dollar-denominated return approaching 70% in just 48 hours. The market stopped valuing companies based on liquidation prices and started valuing them based on the discounted future cash flows of a stabilized, recovering, and potentially liberalized economy. That is the definition of a structural shift, not an inflationary spike.
So if the BBC was the epicenter of local euphoria, the vast volume of institutional money, the really big bets, was moved in the international debt market. This is where the world's most sophisticated funds made their play.
Right. We now shift to the complex arena of sovereign debt. We're talking about the zombie bonds of the Republic of Venezuela and PDVSA. These were instruments that had been in default since 2017. They were considered untouchable deep junk because of the U.S. sanctions that made them so hard to trade or restructure.
The capture of Maduro, then, didn't just change the government. It eliminated the legal and geopolitical obstacle that was preventing any organized negotiation with institutional creditors.
Correct. The removal of the sanctioned regime instantly allowed the market to anticipate a rapid financial normalization and, most critically, the eventual issuance of general licenses by the U.S. Treasury's Office of Foreign Assets Control, OFAC.
And those licenses are the green light.
They are the financial green light needed to facilitate the negotiation and restructuring process with the new interim government.
So how exactly did these bond prices move?
The rally was spectacular and immediate. The benchmark sovereign bonds, like the Venezuela 2027 maturity, they were trading around 33 cents on the dollar before the capture. They instantly jumped to a range of 42 to 43 cents.
So that's an immediate clean gain of 27 to 30%.
Instantly. PDVSA bonds, which had another layer of complexity, also saw huge gains, moving from around 26 cents to about 33 cents.
But the truly staggering figures are the accumulated returns for those who had the foresight, or maybe the stomach to buy at the absolute bottom.
Oh, the long-term distressed debt investors. The ones who bought when these things were trading for scraps, between 6 and 10 cents on the dollar a year or two ago. They've realized accumulated returns from 300% to 400%.
Incredible.
This level of return validates the extreme risk-taking in distressed debt investing. It makes the Venezuelan play the single most successful trade in the global fixed income market recently. It just proves the value of buying assets that have priced in absolute ruin.
Let's talk about the protagonists here. This market move wasn't driven by retail investors. It was dominated by sophisticated hedge funds and firms specializing in distressed assets and litigation, what people often call vulture funds.
These are highly specialized actors. Our sources highlight firms like Altana Wealth, led by Lee Robinson. Altana had maintained a structural, large-scale position in Venezuelan debt since way back in 2020, with estimated average entry prices hovering near that very low range of 6 cents.
And what were the immediate reported gains for funds like Altana in the first days of 2026?
They reported estimated gains of 30% in the first few days of January alone. And Robinson's thesis was remarkably simple but profound. The market price already reflected the absolute worst-case scenario, zero recovery, permanent default. Therefore, any positive political change effectively gave them a free option for a massive upside.
They were betting on the geopolitical impossibility becoming possible.
That's the trade. And other key players, like Broadreach Investment Management and Winterbrook Capital, they also secured massive gains. They were all betting on the inherent long-term value of the country's colossal oil reserves as the ultimate collateral.
The value unlocking process isn't just intuitive, though. It follows a precise legal and financial chain, which is well diagrammed in our source material. Can you walk us through the 5 steps that the capture activated?
Sure, this chain of events is critical to understanding the mechanism of recovery. First, you have the change legal. This is the immediate effect. It ends the usurper status and eliminates the major SDN, the sanctions obstacle. With the executive gone, you now have a recognized counterparty for negotiation.
Step 1.
Step 2 is financial normalization. This is the expected issuance of those general licenses by OFAC. That's the U.S. Treasury authorizing banks and institutions to actually engage in debt negotiation.
Step 3.
The operational phase. This is where the money hits the ground. It signals the guaranteed entry of the oil majors, Chevron, Exxon fully licensed and supported, to recover production capacity. This guarantees the future stream of foreign currency, which is the only way to service the debt.
Okay, that leads to asset protection.
Step 4, asset protection. This is maybe the most critical part for bondholders. Normalization provides legal protection to vital international assets, most notably the U.S.-based refining arm, CITGO.
Which was at risk of being seized.
Exactly. CITGO was vulnerable to disorderly seizure by individual litigating creditors. A normalized environment ensures CITGO and other foreign assets are protected under the umbrella of an orderly global restructuring. It maximizes the total pool of recovery funds.
And the final step.
Step 5, the reconstruction guarantee. The recovery of oil cash flow and the stability from U.S. involvement. It guarantees the funds to serve as a restructured debt package. Now, the restructuring will almost certainly involve significant haircuts, a reduction in what's owed, but the market is now valuing the bonds based on the certainty of a real future payment, rather than the political impossibility of one.
So, certainty of receiving 45 cents is infinitely better than zero certainty of receiving 100 cents.
Infinitely better.
This analysis of the BVC in the debt market highlights massive gains, but direct participation is often inaccessible for the general global retail investor. There are minimum lot sizes, regulatory hurdles, extreme illiquidity. So for our listener, how did global investors play the Venezuela trade without buying local shares or huge bond lots?
That was an excellent point. The access hurdles are enormous. The solution emerged from 2 places: the offshore derivatives market and looking for highly liquid indirect proxies right on Wall Street.
Let's start with the offshore solutions.
Because the local market lacked robust derivative products, speculative capital rapidly shifted to synthetic instruments. International trading platforms saw a massive increase in the use of CFDs, or contracts for difference, which were tied to a synthetic index tracking Venezuelan exposure.
So you're betting on the price without owning the asset.
Exactly. A CFD lets you bet on the price movement of the BVC's index without actually owning any local shares. The reported figure of a 3,361% year-on-year increase in the volume of the index tracked by these CFDs is just staggering evidence of the global speculative interest using these synthetic proxies.
And the clearest sign that the institutional investment machine was mobilizing was the reaction from the ETF industry. Tell us about that Tucrium filing.
Right. The asset management firm Tucrium filed a preliminary prospectus with the SEC for a Venezuela-focused exchange-traded fund. This institutionalization is key. Since a U.S.-listed ETF can't easily hold direct BBC stocks because of regulations and residual sanctions risk, this fund will almost certainly be structured to provide indirect exposure.
What would a structure like that look like?
It would likely hold a basket of international companies with high measurable exposure to the Venezuelan economy. So maybe U.S. service giants, European banks with local subsidiaries, and critically, future holdings of the newly restructured Venezuelan sovereign and PDVSA bonds once they're OFAC compliant.
So it packages the risk.
It effectively packages the geopolitical risk and the recovery potential into a liquid, easily tradable, retail-accessible product. It democratizes a previously exclusive trade.
Now, for the Wall Street investor who wants the highest liquidity, the fastest way to bet on the oil recovery was to buy the companies that are needed to rebuild the infrastructure. Which U.S. stocks acted as the safest, most liquid proxy?
The U.S. oil services sector immediately became the most accessible play. Chevron, CVX, which already had a special license and a physical presence in Venezuela, saw its stock rise 5 to 7%. The market priced in the certainty that Chevron would rapidly expand its operations.
But the real leverage bets were on the service companies.
Oh yeah, the two indispensable oil field services giants, Halliburton, HAL, and Schlumberger, SLB. Both stocks saw immediate gains of up to 9%. They are non-negotiable partners in the reconstruction. PDVSA's deterioration means it needs massive capex and technical support for everything.
And these companies have the tech.
They possess the patent technology and the global capacity to stabilize and increase Venezuelan production rapidly. That makes them direct liquid proxies for the turnaround.
Did this massive event have any spillover effects on regional markets outside of the U.S.?
It did, though the effects were a bit mixed. The most notable reaction was in Colombia. Ecopetrol, the Colombian state oil company, saw some volatility linked to the event.
Why?
It was fueled initially by general positive sentiment toward regional stability. But there's an underlying concern. The long-term recovery of Venezuelan crude could ultimately introduce strong competition for Colombian crude in the American market, so that could temper those initial gains. The region is stabilizing, but competition is definitely coming.
The initial spike has passed. The market has digested the news. The first movers made their 70 or 300% gains. The question now for the smart money is, where are the most attractive opportunities moving forward? Let's turn to the reconstruction horizon.
The opportunity map has fundamentally reconfigured, and we need to distinguish clearly between tactical short-term plays and strategic multi-year positioning. In the tactical short term, the prime opportunity remains bond arbitrage. Despite the massive rally to the low 40-cent range, analysts J.P. Morgan being one notable voice suggests that the ultimate recovery value in an orderly restructuring could be significantly higher, maybe in the 50-70-cent range, depending on the haircut.
So the arbitrage play is about identifying inefficiency. Which bonds lag the movement of the benchmark Venezuela 2027, and then betting on their convergence.
Exactly. Market enthusiasm is often messy. Some bond series, especially those with more complex guarantees or smaller issuance sizes, they might have lagged behind the more liquid benchmarks. The trade is simple. Buy the laggards, expecting their prices to catch up as the restructuring process provides more clarity. It's exploiting a temporary market inefficiency. Another crucial tactical play is centered on currency volatility. The massive anticipated influx of capital humanitarian aid, reconstruction funds, foreign investment will create a temporary oversupply of U.S. dollars. This often leads to what economists call a temporary Dutch disease.
Which means the local currency appreciates significantly, right? Potentially damaging other exports.
Correct. Traders focusing on synthetic instruments or currency pairs can capitalize on this. They'll anticipate a real sharp appreciation of the bolivar against the dollar as foreign currency flows in. This short-term currency strength presents a very acute, high-risk trading opportunity, totally distinct from the equity or bond plays.
Now, here is where it gets really interesting. Let's talk about the strategic potential, the multi-year game. President Trump's focus on fixing the infrastructure suggests an enormous guaranteed capex cycle.
This is the infrastructure supercycle, and it is assured by geopolitical mandate. We're not talking about small projects. We are talking about billions of dollars needed to overhaul critical, devastated systems. Oil refining, the national electricity grid, water supply, road networks. The strategic advantage lies with companies that can secure the first mover advantage in engineering, procurement, and construction. These firms will capture the overwhelming majority of that capex spending. You'd look for large international engineering conglomerates, specialized oil services firms. This cycle is not a 2-year recovery. It's a 5 to 10-year sustained spending commitment.
Beyond the heavy industry, this shift impacts the daily life of millions, signaling a massive return for consumer goods and retail.
This is the massive consumption and retail renaissance, political stabilization, plus the reactivation of credit from liberating the legal reserve requirement in banks that will unleash decades of pent-up consumer demand. People who could barely afford staples will suddenly have access to credit and rising real wages. And the multinationals that maintained a hibernation presence, companies like Coca-Cola and PepsiCo, who kept local bottling plants or distribution networks, they're now perfectly positioned to scale their operations the fastest.
They don't have to start from scratch.
They just have to turn the volume back up. Food and beverage, and later durable goods, will be the first to feel the impact of this demand shock.
And finally, let's look at real estate as a strategic hedge. Where is the 5-year return potential highest?
Despite the rapid rise in local real estate stocks like FVI, the physical property prices in key districts of Caracas are still profoundly undervalued compared to other regional capitals. When you compare square footage costs in Caracas to, say, Bogota, Lima, or Panama City, the gap is just massive.
So what's the play?
The strategic play is acquiring what we call trophy assets, premium corporate buildings, land, high-end hotels at these current distressed prices. Assuming political normalization succeeds over a 5-year horizon, these assets offer one of the highest potential capital appreciation rates in the entire hemisphere. It's transforming scarcity into immense value.
So what does this all mean? We've completed a surgical deep dive into the Venezuelan market shock. The 70% plus BVC rally, the tripling of some sovereign bonds. It's a clear, definitive financial verdict.
It is the irreversible turning point. The market has loudly declared that the decade-long suppression of intrinsic value due to extreme political risk has ended. It's correcting a massive distortion in asset prices. The financial system is already acting as if Venezuela is in a post-political, mandated recovery phase.
But optimism has to coexist with colossal challenges. While the financial markets have moved on, we have to acknowledge the sheer scale of the execution risk that remains.
The risks are enormous and they're unavoidable. The political transition, even though it's supervised, is complex. Rebuilding devastated physical infrastructure, and even more challenging, the human capital infrastructure, that requires sustained, flawless execution.
And the debt.
And, of course, the monumental debt restructuring process. We're estimating between $60 billion and $170 billion, depending on how you calculate accrued interest. That will be fraught with negotiation and potential litigation. Volatility is not just likely in the future, it is absolutely guaranteed as these execution risks play out.
Venezuela has decisively moved from being prohibited financial territory to becoming the most dynamic frontier opportunity in the hemisphere for distressed asset specialists and high-risk capital. Our source material today suggests capital has begun flowing torrentially to where it perceives the highest potential return. Given the extreme volatility we've discussed, and the absolute necessity of that first-mover advantage to capture the best assets and contracts, we leave you with this provocative thought to mull over. What is the genuine difference between an early investor positioning themselves today for this mandated turnaround and a sophisticated speculator taking a massive, calculated risk on the ultimate success of a specific geopolitically enforced mandate? And with that, we conclude this deep dive. We hope this exhaustive analysis has given you a clearer, more nuanced understanding of this historic market event. Thank you for joining us, and we look forward to seeing you for our next deep dive. Remember, in the description, you can find the links to our sponsor, Broker 360, if you need comprehensive insurance management in Argentina, and also to PayPal if you wish to help support the rigorous research behind this program. Thank you once again for your support.